What's up? Fund of Funds. All right, so I know the title of this particular session, which is Fund of Funds, wasn't like the most riveting thing, but we're gonna talk about something very, very powerful that can really like 10x your deal flow. And there's a lot of people in here that are finding it very challenging to make their underwriting work, and they're seeing other teams doing deals, and maybe they're thinking about partnering with those teams, and it's like this whole thing. We're gonna talk about a structure that's gonna allow you to partner with extremely savvy, sophisticated operators without trying to convince them of your worth or anything like that. And I will say that last year I did a keynote presentation on this topic, and it was rated the #1 session of the conference. Unfortunately, as many of you know, yesterday I lost the debate by the largest margin in the history of the conference. So I'm hoping we can kind of get back on our feet over here. So we're gonna talk about fund of funds. This is my partner over here, Rob Overstreet. So Rob, how are you?
Doing great.
Cool.
Glad to be here.
So
Fireside chat. We need the, it's cold outside this weekend.
That's right. So. Just tell us a little bit about your background as an operator and how you start to find out about the structure, et cetera.
Yeah, so Rob Overstreet, my company is Harbor Drive Holdings. We've been in the business a little more than 5 years, active real estate sponsor, syndicator. All our deals to this point had been GP, co-GP side of the table. And met Hunter almost a year ago. I'm in his mastermind group, Raise Masters, the #1 mastermind for capital raisers. So
yes, make some noise if you're in here.
Yeah, I see a couple right in the front row here, a few there we go. So huge value from that. But started learning about this concept of fund of funds. I never really heard that term before. And so within the group and via Hunters, started to understand. And basically, it's helped me in my business because, as everyone knows, in this kind of ramp up phase of the cycle, it's getting more and more competitive to get deals under contract, right? $1 zillion hard up front, or your mom's house hard day one, or your firstborn child, So it's very challenging, right? As an active real estate investor, and I was feeling this pressure to deliver quality investment opportunities to my investor database, which we work tremendously hard on every single day, bringing them value, bringing them education, and just really engaging with them and educating them on the benefits of investing in our world, right? And so the fund of fund was a great way for us to provide high quality investment opportunities to our investor community in the event if we went too long, 4, 5, 6 months without securing our own deals. Because we want to keep that traction with our investors. We want to keep providing them with high quality investment opportunities. So started networking more and more, like events like this, with high quality operators, and was introduced to a group out of the Phoenix area that we started this courtship together. I wanted to learn more about their track record and their process and how they underwrite and how they see the market holistically, make sure we share the same core values. And just these baby steps, and they had an opportunity, and so we organized and raised capital via the fund-to-fund model for the first time on a deal that we closed on in December. So
cool. Awesome. So there was obviously, you have a background as an operator. You've
Yes.
done plenty of deals where you're the main GP. You're making the decisions. You're deciding when to raise rents, how much to raise them, et cetera. And I kind of introduced this concept of the fund-to-fund structure. And so just to clarify what we're talking about, so the fund-of-fund structure, it's like a nomenclature to describe when you have a special purpose vehicle, you pull investors together, and the purpose of that special purpose vehicle is to invest in some other deal, specifically some deal that you're not the GP in, someone else's deal. And so what this allows you to do is pull investors together and invest as an LP investor. And the more significantly you can invest, the more leverage you can go to that thing that you're investing in and negotiate favorable terms for your SPV. Does that make sense to everybody so far? Okay, it's hard to do without a chart here, but the reason a lot of people might want to do this is that a lot of people in this room want to get compensated for raising capital, but they don't want to get a license to do so. It's a very burdensome process. I've done it. I wouldn't wish it on anybody. And the co-GP model requires that you participate meaningfully in the implementation of the business plan. Are you guys familiar with that kind of requirement? So you can't really be compensated for simply just raising money, but in this case, you're pooling investors together to invest in something else. The economics will come to that SPV, and then at the SPV level, there can be an additional waterfall where your compensation is derived. So it might go an 80-20 split to your SPV, and then an additional 90-10 split to your investors, where you're getting the 10. Now, does that make sense so far? Is that a little bit confusing? All right? Raise your hand if you need a little bit more clarification on that. All right, so there's definitely, all right, I gotta take a second to do this.
Yeah, let's go.
Okay, so in most deals, there's an 8 pref with a 70-30 split, or something like that, right? So if I go to an operator and say, hey, instead of an 8 pref with a 70-30 split, I would like to negotiate that if I invest more than $1 million, my entity will get an 8 pref with an 80-20 split. Does that make sense so far? Okay? So most operators will do this as a class of shares. If you invest more than $1 million, you can get an 80-20 split. So at that point, I've created this entity. I'm going to get the 80-20 split as opposed to the 70-30 split. I then can go to my investors and say, here's the thing. I found a great deal. I've created this entity. You can deal with me. And when I invest, I'm only taking the difference that I was able to negotiate between 70-30 and 80-10. So you get the exact same deal if you go direct, but you can work with me. Does that make sense? Okay, so the difference between 80-20 and 70-30 is consequential. It's about 30% of the GP, which is what a lot of capital raisers are trying to get. All right, now we kind of established the structure. We're going to go back to kind of his thinking of how he's kind of working through this. As a general partner, you recognize, even though you are the GP of your SPV, if you invest as an LP entity into something else, you're not going to control that. So how did you kind of walk through that thought process?
Yeah, for us, you know, and in my head, and you know, our investors are busy people. They own businesses, they're doctors, they're lawyers, they're working thousands of hours all the time, you know, like all of us. And they don't necessarily have the knowledge base or the time to really sniff out, you know, undercurrents of risk in this deal versus that deal. You know, everybody's seen everybody's pitch deck, you know, as a, well, am I going to invest in John's or Jane's because this one's a 15 and this one's a 25 IRR? It's like, well, just, you know, shuffle over to the 25. So yeah. The value that we're bringing to our investors is our experience as general partners on deals and all of our years of underwriting countless of, you know, commercial real estate opportunities and being able to identify if it truly is a good deal. And so, you know, for example, I mean, you know, we've been asked to raise capital via SPV, you know, since then on some properties, and the first thing I always ask is, you know, give me the address and your underwriting, and if it doesn't pass that, then it's a no. And I've looked at deals recently that, I mean, quite frankly, and it's no offense to these people, and they're not here, by the way, and I know no one in this room does this, but I just, quite frankly, I wouldn't put my dog's money into their deal, you know what I mean? And so it's like I'm filtering my investors from getting involved with bad deals for one reason or another, usually something derived in underwriting because they have, you know, a 1% vacancy for 10 years straight or something like that, you know what I mean? So, does that answer the question?
So basically, you're good at underwriting, and basically their value that you're doing is you're out there trying to find quality operators with quality opportunities. You're trying to find great deals as well that you can be a GP on, but you know if you're doing one deal a year, you're leaving a lot of money on the table and you're doing a massive disservice to your investors who will forget about you. And that is what we don't want to do. Yeah. If we've put in all this work to grow our investor base, we've got to do a deal a quarter.
Yeah.
And it may be the case that your particular niche is super competitive. You don't want to manufacture your underwriting, so you've got to look at other opportunities. And the fund-of-funds model, now everyone can be your partner, but you don't have to go to them and say, hey, I know what I'm doing about underwriting. I can go visit the property. You don't have to go pitch them about how great of a partner you're going to be. all you're gonna say is, if I show up with $500,000 or $1 million, will you give my SPV favorable treatment? Does that make sense? If it makes sense, say, hell yeah. Okay.
Oh yeah. Yeah.
So
Yeah.
part of the challenge, though, is that you know what you're doing and you don't want to give up a lot of control. So how do you kind of mentally get over that hurdle of like, if you're just investing passively, you're giving up control in exchange for diversification, basically?
Yeah. Just a lot of due diligence on the operator, the sponsor. I need to, understand their track record. I need to understand how they operate, and just all the steps that I would take as an LP myself, except 10x it because, it's not just my money now. It's $2 million of my investors' money going into some other guy's deal that I have zero control over. So. It's again, just taking those steps, doing those due diligence, and really digging in on the sponsor to be sure that A, they're credible, B, they're capable, and after that, it just kind of boils down to the deal itself. So.
Cool. So let's talk about the due diligence process, because a lot of investors are going to say like, why should I kind of trust that these people know what they're doing? Like, what are some of the steps you take to verify some of their claims?
We want to have the conversations about, for me personally, it starts with the underwriting, and so I really dive in deep with the way that they're looking, making their forward-looking projections. I want to see, conservative assumptions moving forward. I really drill into the numbers, and if we stayed here all night, the time would run out because going line by line, but I'm a big numbers guy, and I need to see that. Beyond that, it's track record is a big thing for me, and so I want to see the statements, and talk about the deals they've taken full cycle. How did that go? I always ask to share a couple things that went wrong, and get to understand what they did to mitigate that, and so. Just to highlight a few things.
Cool. By the way, if you're an operator and you're interested in like really supercharging or I guess streamlining the time it takes to get someone to invest with you, especially significantly, talking about really challenging stories that you've had in your career is the best way to do that by far. We've all been the benefactor of very favorable economic trends. But it's not easy to do what we do. We all have scars in this business, and if you don't have scars yet, you're going to very soon. So when an investor asks me about like my background, basically I say, look, we've been the benefactor of really great economic climate. We've been able to achieve pro forma across multiple assets and exceed pro formas on those deals, but that doesn't really matter. Everyone's been able to do this, but here's a challenge that I went through, and here's how we overcame it. And man, that buy-in that can be created by those deals that were really painful, that we had to go way out of balance to solve, that's when the investor understands who they're dealing with. By the way, it's actually how we understand who we are as people as well, and that's where I'm really trying to get to. Cool? So let's talk about fund administration, right? Mm-hmm. So you pool investors together into, what kind of entity is it? And let's talk about like the costs and administering all of those things.
Yeah, so we set ours up, our first one, into an LLC. There are some costs involved with that. So, as Hunter was talking about the improved economics and how that benefits not only the fund manager, but also the investors in the fund. But there are expenses. And, we have our own PPM that, you got to pay for. All the investor documentation, blue sky filing, typical things that you would have to deal with if you're syndicating a deal. On top of that, there's investor portal, maintenance. There's the annual tax filings, and so there's costs involved with operating our fund that are already factored into the main deal. So you have to account for that. But because the economics are better for our fund, it's able to absorb that, and it's able to pay fund manager. And we also charge an acquisition fee. So, if we raise $1 million or $2 million into an SPV model, and then we go direct into someone's deal as an LP, we may actually raise more like 2.1 million, which, obviously factors into investor return profile, et cetera. But again, it's overcome with the favorable economics that we've negotiated on behalf of the fund to fund. As far as the administration, it's very similar to what you would do with a typical syndicated deal. There's, our accounting team accepts the K1 from the main sponsor on our $2 million, and then we just turn around and give it to our CPA team, and they carve up the K1 and allocate it to all of our 20 investors into the deal, and then we return those to them. Beyond that, distributions are similar. It comes in via our investor portal. It factors all of that, and off it goes. So
Totally.
It has a lot of similarities to your typical syndicated real estate deal.
Cool. So just to clarify, so we're on the same page. The SPV is created, investors are pulled into that SPV. Let's say you raise $2 million. You then go invest that $2 million as an LP, which gets favorable treatment because it's a lot of money. Everyone here would probably give that SPV favorable treatment because it's $2 million, only one investor that you're dealing with. That SPV receives a distribution, one distribution to that SPV, and then the SPV manager sends out each of their respective investments distributions to each of their investors.
Pari passu, yeah.
Right.
So,
which is the same thing that happens when the K1s come up. And I want to take just a moment to talk about this. So when you create an SPV, you're creating your own opportunity. You have your own PPM, you have your own marketing deck. You are the general partner of your SPV. You just are investing in someone else's deal. When it comes time for taxes, you will then receive one K1 for your SPV, and then you must turn around and send that K1, basically cut it up, and send it to all of your investors on individual basis. Now, if you guys have been in this business for any time at all, you know that the timing of the K1s is really difficult. Our CPAs, no disrespect, they love to wait until the very last minute. Well, guess what? In this case, that very last minute is the very last minute for us. We receive it at the very last minute. Then we got to turn it around as quickly as possible. So one challenge with the SPV model, because of that, is that we always suggest that our investors extend their return, which can be done for free, as long as you set the expectation up front that they should do it. You can extend it, and you can pay it usually in October. And have you done this yet? We're waiting on this. You're going to be doing it for the first time in a couple months.
All of our previous deals, we've always been on the GP side, so we have much more control over, things like K1, and timing and everything. So we really haven't had to deal with that yet. Because our first fund-to-fund deal just closed in December, I guess we're going to find out. So can we do
follow up?
BEC June in a couple months? Where's Ben? Can we just fire this up again? And I'll fill you all in on how it goes. But
one more point about this, because this is actually important.
Yeah.
It's really important to set that expectation that they should extend. It is free to do. Doesn't cost them anything, and you should get them in the habit of doing that. I haven't filed my taxes on time in years. It's not that I don't pay them. If anyone's listening, I do, but I just pay them later and later and later because I have so many LLCs and et cetera, et cetera. Were you doing multifamily as a GP first?
yes,
Okay, and this recent SPV was also a multifamily deal.
that's right.
But because of this model, you can now do this deal with everyone. Any asset class, any geographic location, any risk profile, right?
That's right.
Are you anticipating doing that?
Yeah, we're interested in a couple different asset classes that I don't personally have a lot of experience with, but would love to give my investors exposure to because I believe in other asset classes and diversification, et cetera. And so using our experience being now on both sides of LP and as well as under the hood GP experience, we are looking forward to bringing some additional, other opportunities to our investor database for consideration.
This is massive. Because if you believe in diversification, like one of the lessons of economics is that to have a market advantage over your competitors, you must be hyper specialized. You must be really, really good at doing one thing, right? The challenge with that is antithetic to financial planning. You don't want to have your entire net worth all on the east coast of Florida. Florida is booming, it's awesome, but every now and then there's a hurricane that's going to come and just smack that portfolio. So I want to have diversification in Florida, I want to have it in Phoenix, in Austin, all around, and it's not just multifamily. Self-storage, mobile home parks, I think Ing was on the stage earlier, big fan of him. I don't want to have to learn everything there is to know about Bitcoin mining. If I can just find a sponsor and then go to that sponsor and negotiate those favorable terms, it's on, right?
That's right.
Cool.
Yep.
Let's talk about like the economics of this in the sense of how much can someone make on a percentage basis by implementing something like this?
As a fund-to-fund manager?
Yes.
Yeah. So, for our first one, I think in sequential in the future, we'll probably do it differently. And there's a zillion ways you can do any real estate deal, right? But I'll just walk through the way we worked it out, just to give some context. But in our minds, we're thinking, well, these are our investors, and so we want to give them at least, what they would get if they went directly to the sponsor, right? We don't want to shortchange them because they're going through me. So we kind of reverse engineered the structure. So it went like this. Sponsors, retail investors get the standard treatment every single deal they do, and that is a 7 pref, a 70-30 split above the 7. And then as soon as the LPs hit a 2x multiple, the split goes 50-50. Okay, so that's their retail investors.
Real quick, just because I know it can get confusing, that would be the sponsor in this case, the sponsor that they're contemplating investing in. That's their normal structure.
That's the sponsor, okay, and they're retail investors. The sponsor gave us, and therefore our fund, an 8 pref, an 80-20 split, and they dropped the 2x hurdle, at which point it would go 50-50. So to recap, if one of my investors went directly to the sponsor that we did the fund-to-fund with, they would get a 7 pref, and then a 70-30 split, and then 50-50 above a 2 multiple. Our fund is receiving an 8, an 80-20, and no hurdle. So that arbitrage is the profit to our fund, okay? So just setting the table. Within our fund, we gave our investors a 7% preferred return, and then we did a 90-10 split, and no hurdle. So at the end of the day, if this deal hits a walk-off-the-park home run, investors in my fund can potentially earn more than investors that go directly to the sponsor because we don't have that 2x hurdle. And the reason that we did it, the splits and carved it up in the way that we did was, because we reverse engineered. We wanted to make sure that we were, pretty much right in line with what they would get if they were a retail investor in the other deal anyways. So that gap, that extra money that comes through our fund helps pay for fund expenses, which aren't much, a couple thousand a year for the K1 filing, a few $100, here and there throughout the year for servicing our investor portal, and that's pretty much it. Also, we did charge a 2.5% organizational fee in the fund, and we raised that at the front end. And on pro forma, right, and this is a 5-year project, on pro forma, we expect to make something around 12 to 14% of the money that we raised through the fund.
We're going to do a round of applause real quick about that.
Yeah.
Okay, so let me just restate what he said, okay? For every $1 million they raise, they're going to make around $140,000 over the 5-year period when it goes full cycle. But the cool thing is that they don't have to do any work on the actual property level during that 5-year period. They raise $1 million, they invest it with the sponsor's doing all the work, and in the meantime, they can do other deals. In other asset classes, other ventures, they can focus on growing their investor base. It just really, really supercharges the amount of deals you can do, and it's really economically similar to being a GP, but it removes the risk and the requirement to do a lot of work. And there's some challenges with the GP model. Let me just summarize this really quickly just to further motivate people to kind of contemplate doing this. So the co-GP model is the oldest model in real estate. It's very typical in real estate to have 2 partners, one that focuses on operations, one that focuses on marketing and capital raising. So because of that, people go into a deal, they go, hey, 50-50, you do the capital raising, I will do the operations, we'll split everything 50-50. The SEC has got no problem with that. The problem is, as we start to do bigger and bigger deals, it's difficult for that one person to bring in 100% of the equity all of a sudden. All of a sudden, you need $40 million of equity. You want to buy a $100 million property. Now you start thinking, maybe we need 10 partners each that are going to raise whatever, $5 million to do this deal. The problem is, as you bring in those 10 partners and they all end up raising different amounts of money, the SEC can see that their compensation is directly tied to how much money they brought in. It's clear that you're basically paying them to raise money, which you need a license to do. So in order to overcome all this, I don't want people to stop buying $100 million properties. I want them to correctly have just different really high investment amounts from various fund of funds managers. Cool?
Yeah. Yeah, no, that's exactly right. It's a very legal way to do it, and we've all, had conversations with our securities lawyers, but exactly right. And by the way, I had lunch with my attorney today, and he asked me to tell you all that I am not an attorney. So, but that's right. It's like you see these co-GP deals where there's 19 people each bringing in $50,000. I mean, you're playing with fire when you do that.
It's difficult. And, this business, generally speaking, the securities laws and regulations are very challenging. It's very difficult to stay within the lines. And this is all done behind closed doors. But when things go wrong at a macro scale, the tailwind can get really nasty where the SEC starts looking around. And I just don't want people to have challenges with that stuff. Do you ever pool investors together to then invest in multiple deals, multiple asset classes, multiple risk profiles?
I don't.
Cool.
I don't do that, yeah.
So I've kind of made the case that if you're pulling investors together, you should only invest in one deal that they have full insight into what they're getting into. Because if you don't do that, if you have a real estate fund that investors are investing into your fund and you're buying real estate, you're not acting as an investment advisor. From my personal perspective, I'm not an attorney, far from it. Because you're buying real estate. The definition of a registered investment advisor is someone who pools investors together to invest in securities. The challenge with the fund of funds model is you are investing in securities. You're not directly owning real estate. Okay, I'll say it again. A real estate fund is pooling investors together to buy real estate, multiple different pieces of real estate. You're not an investment advisor because they're not deferring to you to invest in securities, which defer to a third party. If I am a fund manager, I control the real estate. However, if you pull investors together in a fund of funds, you're then investing in securities to a large degree because there's a third party that controls everything there. If you have questions about this, Byron is actually in the other room presenting, just ask him. But my message to you would be, don't pull investors together and then invest in a bunch of other people's deals at your discretion, because that discretion is literally the definition of an investment advisor. Yeah. Kind of confusing, but that's the takeaway. Cool?
Yeah. Cool. I had a conversation with Byron recently, and we were talking about that concept of like a blind fund where, let's go out and raise, $50 million and we buy all this stuff. He's like, well, the way it was explained to me, again, I'm not an attorney, they told me not to tell you that, but the PPM is there to protect all parties, including the sponsor, and so you want your PPM to be as clearly just drilled down, defined as possible. And so if you want to go raise $50 million and buy a multifamily and a mobile home park and something built in 1920 and something built in 2020, all this mixed bag. It's like, he's like, that is very, very gray area because the investor has no idea, really because it's not clearly defined. So talk to your counsel, but that's, the way it was explained to me, one
Totally.
PPM, one deal, cleanest way, black and white,
And not to get too confusing, because I can see a lot of you are like, what is he talking about? But you could create a fund of funds that would then invest in a fund, but I don't want you to create a fund where your investors are deferring to you. Because if you don't control the things in which you're investing, you are meeting the definition of an investment advisor. There's a whole nightmare of regulatory hurdles that you have to go through. It's possible, but you do not want to do it. Does that make sense? Okay, what's up? I don't know if you're allowed to ask a question, but I'm going to make the rules, so yes, what's up? Really quick, I'm going to say it for the mic.
Yeah.
So the question was, how challenging was it to onboard your investors for the SPV model when they're used to you being the operator?
There were definitely some questions about it, but I just explained, listen, we've done extensive due diligence on the sponsor. We've been working very closely with them. I actually went to the property. I wanted to see it myself because I knew that there'd be questions about, hey, what kind of neighborhood and these sorts of things. I didn't want to just like, sure, I take your word for it, like whatever. But I explained to them, hey, this is something a little different. It functions very similarly for purposes of, you, Mr. Investor, but we're establishing this fund. And we're allocating as one single, limited partner into somebody else's deal in which I will not have control over. And honestly, it's probably just because of the relationships I built with my investors over the years. They didn't have any pushback, really. They said, all right, sure. So I mean, that's the goal. If you can get there with your investors and to where they'll follow you no matter where you go. I mean, that's and again, and we work very hard at that. I mean, it's a daily, every single day is giving value, nurturing our investors, communicating often. We were listening to Hanford earlier this morning. Communication, right? Just constant communication with your investors. So, my wife says I talk too much. So that was a long-winded answer of saying, but yeah. So,
cool.
Yeah.
So it's an exercise in leadership.
Mm-hmm.
All right, we are leaders, we are entrepreneurs, we have to lead our investors where we want to take them. And if you're not taking that approach, you're going to be competing over price. And that is not a good position to be in. So all of the kind of mental clutter around, oh, my investors are never going to go for this, they want to trust me, all that stuff, it may be true, but you can overcome all of it. You can overcome all of it by being the leader to your investors and say, look, I don't want to put you guys in bad deals. We only operate in Oklahoma City, and this market is extremely competitive. Not a shot, I don't really know anything about that market, but you get what I'm saying. I've found an incredible opportunity in Austin, Texas, and the cool thing is these guys have done $1 billion worth of commercial real estate. I'm strategically partnering with this group, giving you access to them. The economics are exactly the same as if you had gone direct, but you get to still rely on me. Now, a question that a lot of them have is, hey, I really like getting depreciation when I invest, but will I still get that benefit if I'm investing through this SPV? The answer is absolutely, yes you can. The K1, the tax document, will show that depreciation coming to the SPV and then getting up divided just to the individual investors. It's a question we get all the time. Anything else that came up that you want to talk about, that people are giving you pushback, or even things that you were contemplating they might give you pushback on with this particular structure?
That was a really good question. Is just the questions about the fund. I've never seen this, and honestly, it really wasn't that big of a hurdle. I mean, anything else? I mean, yeah.
Well, asset class is one that comes up all the time.
Yeah.
And I'll tell a little story about my failures as a capital raiser, because I have many. We put out a deal right as the Delta variant was becoming popular. We put out a senior living deal, and the capital raising landscape in senior living changed over an instant. We all thought we were kind of out of the woods, and the Delta variant came in, and it was really, really a different landscape in terms of raising money for the senior living space. And we did not do a good enough job of priming the pump for this particular opportunity. So if you're contemplating doing this right now, and this is really, really powerful from a marketing standpoint, constantly tell your audience what you're working on. If it's too early to tell them the specifics, just tell them that you're working on something really exciting and that they'll tell them what it is really, really soon. And I know that sounds silly, but curiosity is the mecca of marketing. You want your audience to follow you along on this journey. So what this allows you to do is that, hey, I'm starting to talk in Austin with some operators. I don't really know if there's an opportunity yet, but Austin is one of the fastest growing markets. The rental rates are out of control. It's extremely competitive. So in order to get a deal, you got to buy $100 million a year. So 2 months later, we're still working in Austin, et cetera. This will prime them for this opportunity. And it's definitely true if you're going from multifamily to Bitcoin mining. So you can never over-communicate any potential pivots in your audience. And if you do this correctly, like Rob said, You will never have to worry about raising capital again for anything, not just real estate. You want to raise money for a startup that you're creating, you want to raise money for some technology that you came up with, you want to do something for charity, you'll be able to pivot your audience permanently. I know right now, I could launch a bowling alley and it would be funded instantly because of what we've done. It takes a lot of work of communicating, over-communicating, et cetera, but you cannot do that too much. Any comments on that?
No, that's all exactly right. The one thing I'll say for all the active investors out there is, again, you start to build, it becomes a snowball effect with your investors. The more often you raise, the more capital you're going to raise, right? You get more referrals. They want that steady, consistent deal flow. So if you're not providing them with that, if you're not raising capital at least 4 times a year, this is a perfect alternative. I'm not saying that we're not going to stop looking for our own deals. In fact, that's not the case whatsoever. We're on the doorstep of one we talk about, and we're going to continue to look for our own deals as active GPs, co-GPs. But if I'm going 3, 4, 5 months and we're out there kicking bushes looking for our own deals and we don't have a raise, then I'm gonna set up the next fund to fund SPV and continue to provide my investors that value. I mean, I'm not doing them any good service if I'm not giving them consistent opportunities for their consideration on high quality opportunities with high caliber operators.
Totally. All right. Now, this whole conversation we've been talking about if you want to diversify out of your particular niche. But raise your hand if you would really love to have a $2 million investor that doesn't require any control rights. Raise your hand. Okay. This is the easiest thing in the world to do. Talk to your attorney. In your next deal, have them create an additional class of shares that outlines what we just said to attract fund of funds managers. It's free. Instead of it saying Class A, LP investors, Class B, general partner, there's going to be a new class of shares. Now it's going to go Class A, 7 pref with a 70-30 split. Class B, if you invest $500,000 or more, 8 pref with an 80-20 split. Class C, general partner. Just having that on there will likely attract fund managers. And by the way, every now and then, one of your normal investors that's been investing $200,000 every clip, all of a sudden they came up with $1 million because everybody likes a good deal. This is really, really powerful stuff. I have seen this from all angles. From an LP investor, I've seen this from a fund manager perspective and from an operating perspective. The cool thing is, like I said, this isn't like you have to create some new business plan. You just say Class B 80-20. Cool? I'm not allowed to, what's up? Let's go. Oh gosh, great question.
I'll add.
Please repeat it.
So
repeat the question real quick. Yeah.
The question was, no, I'm saying you're going to answer it.
Okay, go.
And I'm going to repeat the question.
You're the man.
The question was, if the main deal is a 506c offering, does the fund to fund have to also be a 506c offering? So.
Okay, so this is definitely a question I would want to talk to my attorney about. But if the main offering is a 506c offering that requires only accredited investors, then only accredited investors can own interest in that entity. And there is this concept of a look-through component, meaning it will look through to the next entity and to their individual investors. So I cannot have non-accredited investors pooled together into an entity that invests into an entity where only accredited investors exist. Does that make sense? I think that's what you're looking for. Now, there's a couple of different confusing points with the 506B, 506C thing. From my perspective, you want to make it aligned always. If the main offering is a 506C, you should definitely do a 506C for a lot of reasons. If the main offering is a 506B, and your question is, can I do a 506C? I don't want to get too technical. The answer is you can do a 506C. It can be only accredited investors, but I would not publicly solicit investors to that entity because that entity is directly investing into an entity that doesn't allow that. All right? So I'm going to be around for about 20 more minutes. I'm happy to answer any questions over there. Oh, real quick, I do have a QR code that I sent them at like 1 in the morning after having like 3 margaritas. So if they could put the QR code up there. We do have a mastermind that talks about fund of funds, capital raising, marketing, just kicking butt, generally speaking. I'm a huge proponent of the capital raising side of the business. It's where the money's at, obviously. So if you want to take a picture there, I have a free webinar that's coming up on Monday where we're going to do like an hour and a half of capital raising content. It's 120 slides. The time is running out. I'll see you guys over there by the booth for like 20 minutes. Make some noise for my man.
Yeah.